Welcome back to Intelligent Investment Today, the podcast concerned with all things value investment. In each episode, we consider a different topic from the investment landscape and consider how we can apply the lessons as laid down by the man widely considered to be the father of the craft, Benjamin Graham, to the problem at hand. In this episode, we consider some of the personal characteristics that are often shared by the value investor. We're talking here primarily about an often ingrained thriftiness and need to obtain value for money, whether that's in the purchase of stocks or socks. We'll see why spending wisely and being frugal in all our financial decisions is the only sure way to build wealth over the long term. So without further ado, let's get right down to it. As ever, sit back, strap in and get ready to take on board another lesson in value investment as inspired by Benjamin Graham. Now, at the risk of upsetting some of you lot, value investors, in my experience, have a bit of a reputation of having very deep pockets. So deep, in fact, our arms can't reach to the bottom to pull out any cash. To many of us, money is our scorecard, and wherever possible, we like the flow of it to be one-directional. This is not to say that we are an altogether ungenerous bunch. That's not what I mean at all. I think we always make sure to tip our fair share and donate to good causes. But in every other respect, when it comes to the purchase of goods or services, we want to make sure that we obtain more than we pay for. This is why I think that in some respects value investment cannot be taught. People in general are drawn towards the investment style because it is already very much part and parcel of their character. If someone wants the best deal on their multi-pack of Coca-Cola, then surely the same will apply whether it's the purchase of a car or their stocks. Whether this need to obtain a bargain is innate or a learned behaviour is another question altogether. Nature or nurture? All I can say is I certainly did learn a lot from my mother when it comes to an eye for a bargain. Her Christmas shopping for the upcoming year always being completed before the end of the January sales season. We can also look to the example as set by Warren Buffett. Bill Gates once recalled a story of when Buffett treated him to lunch at a Hong Kong branch of McDonald's. Buffett insisted on paying for his fellow billionaire's cheeseburger and fries, and then Gates recalls him digging deep into his pockets to pull out loads of coupons. Similarly, Buffett has a pretty fixed breakfast routine. Every day on his way to Berkshire Hathaway's offices in Omaha, Nebraska, he will pull into his local drive-through branch of McDonald's. If his stocks were down the previous day, he will generally opt for 2 sausage patties at $2.61. But if he is up, then he will splash out on the $3.17 bacon, egg and cheese biscuit. Of course, 57 cents isn't going to make a lot of difference to a guy worth $150 billion. But this is, of course, not about the money. It is about who Buffett is as a person. He wants to obtain value, and it niggles at him if he feels like he's not getting it. As an aside, Buffett also lives in the same house that he purchased way back in 1958 for $31,500. Today, it's estimated to be worth around $1.5 million. And of course, it's a very nice house, but it certainly isn't your typical billionaire's house. But it would seem he's happy enough there. And he doesn't ride in the back of a Rolls Royce. He in fact drives a 10-year-old Cadillac. And before anyone mentions it, yes, I do know he bought a $7 million private jet back in 1989. But to be fair to him, he did initially name it the Indefensible, although later changing that name to the Indispensable, which proves at least he thinks he's getting good value for money from it. Although it must be said to call Buffett frivolous for spending $7 million on a private jet is probably dollar for dollar the equivalent of judging my lifestyle choices for buying a dishwasher. Anyway, he now of course has a fleet of 1,100 aircraft to call upon through Berkshire's ownership of NetJets, so he isn't going to have to worry about legroom anytime soon. Buffett's stance in regard to materialism is similar to virtually every value investor I know. We don't mind spending money if we feel it will genuinely improve our lot, but we'd rather have the money in the bank, thank you all the same. We don't move to a bigger house if we're happy where we are. All those extra rooms do need to be heated, don't you know? And we don't change our car every couple of years to impress the neighbours. And we do love Casio watches, the official timepiece of the value investor. This is of course part of our character, and it is how we would behave if we were a value investor or a window cleaner. But this need for spending money wisely, or if possible not at all, does come with an added element when it comes to those investing money in the stock market. Unlike the general public as a whole, we are well aware of the idea of compound interest, and this makes everything appear to us to be that much more expensive. Let me explain. So your next door neighbour has just bought that $70,000 Mercedes, the one that uses witchcraft to automatically turn on the wipers when it rains. So there is that added motivation to upgrade your current rust bucket, lest you bring the neighbourhood into disrepute. You can do without the magic wipers, the auto headlights and the massage seats. And you can get something that looks pretty smart for $40,000. Something that will at least convince the neighbours you're not totally down on your luck. But then the training kicks in. Hang on a minute, $40,000 compounded at 15% over 10 years. That car won't cost me $40,000. By the time its value has been reduced to naught, it will have cost me over $100,000 over that period, and close to $300,000 over 20 years. And at this point, you pop out to the garage to get the touch-up paint. The analogy that I like to use concerning material possessions is around the 80-inch LED TV. Now, we've all done it. We have all at one stage or another believed that our lives would be so much better if only we had a massive oversized TV stuck to our living room wall. Now here's the thing, when you first install it and switch it on, it's pure bliss. How do we ever cope with that old 60-inch thing? And you can now put the binoculars away when you're watching the football. But after 3 or 4 days, you don't even realise the difference from what you had before. It becomes the norm and it's nothing special anymore. And this is the case I find with virtually every material possession. You get that lovely new car, it's your pride and joy. You park it at the furthest point from the entrance at the supermarket. So fearful are you that someone might park next to you and brush past the pristine paintwork. You wash and wax it every day after work, yet after 2 or 3 months it just becomes another car again, a means to get from A to B. You don't think twice about bumping it up the curbs, and why bother washing it, it's only going to get dirty again. And exactly the same thing applies to TVs as it does to houses or apartments. The big house feels so much more roomy and spacious than the little box you lived in before. But before too long, it just feels like somewhere else to eat, drink and rest your head. Material possessions, when they are new or novel, provide a quick dopamine fix. But this, I guarantee, will wear off pretty quickly. People like Warren Buffett are well aware of this. So why would he waste his money? Especially money that he could use to invest in businesses that will provide a sustained dopamine fix one way or another. Naturally, the vast majority of the general public don't see things in this way. And it's probably a good thing for our economy that they don't. They believe money is there to be spent, and they are probably exactly right on this score. But the typical value investor has a very peculiar hobby. They like to collect money, and spending money on frivolous things is harmful to this pastime. People might be keen to point out that you're going to die a rich old man or woman, to which I would reply, I'm still waiting to hear what your point is. In conclusion, we can say that the typical value investor has not become a value investor because they've read about it and thought that's the way to get rich. Of course they might have done that, but they won't last 5 minutes when they realise how dull and uninvolved value investment can be. There are plenty of other schemes out there for those guys that promise false riches much more quickly than through value investment. The typical value investor will have been attracted to this particular investment style because it best reflects who they are as a person. It is unlikely that someone who is prepared to pay over the odds for products and services in their day-to-day dealings will suddenly feel the overwhelming need to demand value for money when it comes to their stocks. To become a great value investor takes time and training, of course. There is a lot to learn, but ultimately you cannot teach someone to be cost sensitive if that is not who they are as a person. It has got to really rile you to pay too much for something in order to become any good in this game at all. You'd almost rather die than pay over the odds. And I'm not certain that is something that can be taught. You've either got it or you haven't. To those for whom wealth is a scorecard rather than a means to live the high life, value investment can become a very worthwhile endeavour. For those who would rather impress the neighbours with a flash new Mercedes, I honestly don't think your head is in the right place to do very well in this game. On that, I shall draw a close to this edition. If you've enjoyed it, please do consider adding to playlist. That way you'll be alerted whenever a new episode lands on your platform. Like the world's worst Terminator, I'll be back again soon with another new topic to discuss, and will once again be looking to apply the lessons as laid down by Benjamin Graham. I'm David Coombs, this has been Intelligent Investment Today. Until next time, stay safe and happy investing.